Before we dive in, it is crucial to understand that the information provided in this video is for educational and informational purposes only. I am not a licensed insurance agent or financial advisor. This presentation is not intended as a substitute for professional advice. You should always consult with a qualified and licensed professional before making any decisions about purchasing insurance products. The world of insurance is complex and your individual needs are unique, so please do a thorough review of any policy and seek personalized advice. He was on the trip of a lifetime, 2 weeks backpacking through Vietnam. He'd saved for a year, planned every detail, and was having an incredible time. Then, on a rented scooter outside of Hanoi, it happened. A dog ran into the road, he swerved, and the next thing he knew, he was waking up in a small rural hospital with a shattered leg. The doctors were kind, but they didn't speak much English. The facility was basic. And then came the first bill, and the second, and the call from his U.S. health insurance provider that delivered the gut punch. We're sorry, but your plan does not cover international incidents. You're on your own. His dream trip instantly became a $100,000 nightmare, not including the astronomical cost to fly him home on a specialized medical flight. This story isn't a rare one-in-a-million horror film. It's a terrifyingly common reality for American travelers, and the single biggest, most financially devastating mistake you can make when you leave the United States isn't forgetting your passport or booking a bad hotel. It's fundamentally misunderstanding how health and money work the second your plane leaves U.S. airspace. We live in a country with the most expensive healthcare system in the world, and we are conditioned to think our insurance card is a golden ticket. But in most of the world, that card is just a piece of plastic. Here's the hard truth: your domestic insurance company probably buried in the fine print of your 200-page policy document. The vast majority of U.S. health insurance plans, including many PPOs, HMOs, and even Medicare, offer little to absolutely zero coverage overseas. They might cover a true life or death emergency at an out-of-network rate, leaving you to fight them over the bill for months. But for everything else? A broken arm in Italy, a severe case of food poisoning in Mexico, that scooter accident in Vietnam? You are paying for that out of pocket. And the costs can be life-altering. A medical evacuation from a remote location can easily top $100,000. A few nights in a private hospital in Western Europe could run you $20,000, $30,000, even $50,000. We're talking about retirement-destroying, home-losing amounts of money. So how do you protect yourself? How do you turn this massive, terrifying uncertainty into a simple, confident decision? That is exactly why I made this video. This isn't just another boring talk about insurance. This is your ultimate checklist. Your step-by-step guide to decoding the confusing world of travel health insurance, so you can find the right plan, for the right price, and travel with true peace of mind. By the end of this, you will know exactly what to look for, what questions to ask, and what red flags to avoid, ensuring you are never ever that person in the horror story. First, let's clear up the biggest point of confusion. What we're focused on here is travel health insurance, sometimes called travel medical insurance. This is not the same thing as the trip cancellation insurance you get offered when you book a flight on Expedia. That stuff is great for getting your money back if you have to cancel your trip. But it often has shockingly low medical coverage, maybe $5,000 or $10,000. That's not enough to cover a sprained ankle in Switzerland. What you need is a dedicated policy designed for one primary purpose: to protect your health and your wealth when you are outside of the United States. So let's get out our checklist. Grab a pen, open a notes app, because this is the foundation of everything. The very first item on your checklist, the absolute non-negotiable, is emergency medical coverage. This is the core of any good policy. It covers the cost of treatment, hospital stays, doctor visits, ambulance rides, and prescription drugs if you get sick or injured on your trip. The key here is the coverage limit. This is the maximum amount the insurance company will pay out. Do not cheap out on this. I see policies advertised for a few bucks a day with a $10,000 limit. That is useless. It's a false sense of security. For international travel, you should be looking for a minimum, an absolute bare minimum, of $100,000 in emergency medical coverage. If you are traveling to a country with expensive healthcare like in Western Europe, or if you're older, or if you're doing any kind of adventurous activities, I would strongly recommend looking for plans with $250,000, $500,000, or even up to $1 million in coverage. The price difference is often surprisingly small, but the difference in protection is monumental. Think of it this way. You're not insuring for a common cold, you're insuring against a catastrophe. And you need a catastrophic amount of coverage. The second item on your checklist, and it is just as critical as the first, is medical evacuation and repatriation. This is a separate benefit with its own coverage limit, and it is one of the most misunderstood and dangerously overlooked parts of any policy. Medical evacuation is not treatment, it is transportation. If you have that scooter accident in a rural Vietnamese village, the local clinic might be able to set a bone, but they can't perform complex surgery. Medical evacuation coverage pays to transport you, via helicopter, plane, or specialized ambulance, to the nearest high-quality medical facility that can properly treat you. This alone can cost $50,000 to $100,000. But it gets even more important. Let's say you have a major medical event in Tokyo. The hospitals are world-class, but you're stable enough to fly, and your doctors agree the rest of your long recovery should happen back home. That's where repatriation comes in. It pays for the medically supervised flight to bring you all the way back to the United States. A commercial flight with a medical escort can be $25,000. If you need to lie flat on a stretcher, it can mean buying out a whole row of seats costing upwards of $50,000. And if you're in critical condition and need a private air ambulance, you are looking at $250,000. Easily. Your U.S. health plan will not touch this. Your trip cancellation plan won't cover it. Only a robust travel health insurance policy will. When you look at policies, make sure medical evacuation is a distinct line item. Don't just assume it's included under the general medical benefit. Look for a high coverage limit here as well. A smart baseline is $500,000. $1 million is even better. It sounds like an insane number, but it reflects the insane reality of how much this critical service can cost. Without it, you could be faced with an impossible choice. Get substandard care where you are, or drain your life savings to get the care you need. It is an absolutely essential piece of the puzzle. These first two items, high-limit emergency medical and high-limit medical evacuation, are the two pillars of any worthwhile plan. If a policy is weak on either of these, walk away. But there's a third element, a sneaky trap that invalidates coverage for millions of Americans without them even knowing it. And it has to do with the health conditions you already have before you even leave your house. This trap is called the pre-existing condition exclusion, and it's the #1 reason legitimate claims are denied. Let me tell you about a guy named David. David was a 58-year-old software engineer from Austin, Texas. He was active, loved to hike, and had been planning a trip to Peru to see Machu Picchu for years. Like a lot of guys his age, he had high blood pressure, but it was completely under control. He took one little pill every morning, his numbers were great, and his doctor said he was in fantastic shape. It was a total non-issue in his daily life. Before his trip, David did the responsible thing. He bought a travel insurance policy. He saw it covered up to $100,000 in medical emergencies. He thought, great, I'm covered. He packed his bags, his blood pressure medication, and flew to Cusco. A few days into the trip, while acclimatizing to the high altitude, he started feeling dizzy and had a crushing headache. He collapsed. It was a hypertensive crisis, a sudden severe spike in blood pressure, likely triggered by the altitude. He was rushed to a local clinic, stabilized, and thankfully he was okay. But the bill for the emergency care and the few nights in the clinic came to over $9,000. No problem, David thought. He had insurance. He filed the claim, and a few weeks later he got a letter in the mail. Claim denied. The reason? His high blood pressure was a pre-existing condition. David was floored. He called the insurance company, furious. But it's managed, he argued. My doctor said I was perfectly fine to travel. The agent on the other end of the line calmly pointed to a single clause buried on page 27 of his 40-page policy document. It was called the look-back period. This is the term you absolutely have to understand. The look-back period is a set window of time, usually 60 to 180 days, directly before you buy your insurance policy. The insurance company will look back into your medical records for that entire period. If you've had any symptoms, any tests, any treatment, or any change in medication for any condition during that window, that condition is officially considered pre-existing and is excluded from coverage. Here's the detail that destroyed David's claim. 3 months before his trip, during a routine checkup, his doctor had made a tiny precautionary adjustment to his blood pressure medication dosage. Not because anything was wrong, but just to fine-tune it. To the insurance company, that medication change was treatment within the look-back period. It was the smoking gun they needed. His condition was not considered stable. And just like that, his $9,000 claim went up in smoke. He was on his own. This story isn't an exaggeration. It happens every single day. People with perfectly managed asthma, diabetes, a heart condition, even a recent bout of physical therapy for a sore back, get their claims denied. They think they're covered, but they're not. So how do you protect yourself from this? How do you make sure the health conditions you already have are actually covered in an emergency? You need to look for a magical feature called a pre-existing medical condition exclusion waiver. That's a mouthful, I know, but writing it down and looking for it could save you tens or even hundreds of thousands of dollars. A waiver, when you qualify for it, essentially tells the insurance company to ignore the pre-existing condition exclusion. It forces them to cover your existing conditions, just as they would a brand new illness or injury that happens on your trip. But here's the critical part. You don't just get this waiver automatically. You have to earn it. There are usually 3 very specific conditions you must meet. If you miss even one, you don't get the waiver. First, and this is the most important rule, you must purchase your travel insurance policy within a short time frame after making your very first payment for your trip. This is called the time-sensitive period. It's usually between 14 and 21 days. So, the moment you put down a deposit on that flight, that cruise, or that tour, a clock starts ticking. If you buy insurance on day 22, you've missed your chance for the waiver. They do this to prevent people from buying insurance only when they start to feel sick right before a trip. So rule number 1, buy your policy right after you book your trip. Second, you must insure the full, non-refundable cost of your trip. You can't just insure your flight and not your prepaid hotel. You can't lowball the amount to try and get a cheaper premium. You have to insure every last non-refundable dollar you've spent. If your trip costs $5,000, you need to insure $5,000. Third, you must be medically able to travel on the day you buy the policy. This is common sense, but it's in the fine print. You can't be in the hospital and then decide to buy a policy for a trip next month. If you meet all 3 of these conditions, you buy early, you insure the full cost, and you're fit to travel. Most comprehensive policies will automatically include the pre-existing condition waiver. You don't even have to ask for it. It's your reward for being a responsible, proactive traveler. So your checklist item number 2 is this. Does the policy offer a pre-existing condition exclusion waiver? And can you meet the requirements to get it? When you're comparing policies online, there is often a checkbox or a filter for this specific feature. Use it. Never ever consider a policy that doesn't offer this waiver, especially if you have any medical history at all. And let's be honest, in the United States, most adults do. Think about it. A knee that acts up sometimes? Pre-existing. That anxiety you take medication for? Pre-existing. The acid reflux that you have under control? You guessed it, pre-existing. Without that waiver, a flare-up of any of these on your trip could be excluded from coverage, leaving you with a massive bill. The false sense of security you get from just having insurance is more dangerous than having no insurance at all, because it makes you take risks you otherwise wouldn't. So we've established that your policy must be underwritten by a real insurance company. We've established it must cover your pre-existing conditions via a waiver. You're now protected from the 2 biggest backdoor gotchas in the industry. But now we get to the money itself. When you're lying in a hospital bed in a foreign country, how exactly does the money get from the insurance company to the hospital? The answer to this question separates the good policies from the great ones, and it can mean the difference between getting immediate top-tier care or having to put a $50,000 charge on your personal credit card and just praying you get it back later. And let's be brutally honest for a second. Praying is not a financial strategy. Hope is not a line of credit. When you're in a foreign hospital, potentially alone, in pain and scared, the absolute last thing you need is a second crisis layered on top of the first one. A financial crisis. A crisis where you're frantically calling your credit card company from a pay-by-the-minute hospital phone, begging for a temporary credit limit increase, trying to explain in broken English to a billing administrator why the payment is going to be delayed. It's a nightmare. It's a preventable nightmare. And avoiding it begins with understanding the single most important number on any policy you look at. This is our next major checklist item, and it's called the overall maximum limit, or sometimes the maximum medical benefit. This number is the absolute ceiling on what the insurance company will pay for your medical expenses. It is the total size of the safety net they are offering you. If your medical bills exceed this number, you are on your own for the rest. Let me say that again. Anything above this number comes directly out of your life savings, your kids' college fund, or the equity in your home. So this number isn't just a detail. It's the foundation of your entire financial security while you travel. Now, you might see a policy for a $30 trip to Cancun and it offers $25,000 in medical coverage. And you think, 25 grand? That sounds like a lot of money. My appendix isn't made of gold, what could possibly cost that much? This is a dangerously common mistake. We are so used to the completely warped and opaque pricing of the US healthcare system that we've lost all perspective on what things actually cost. In many parts of the world, especially in countries with excellent healthcare like Switzerland, Germany, or Japan, the cost of high-quality care can be astronomical for a non-resident. A severe broken leg from a skiing accident in the Swiss Alps? You're not just paying for a cast. You're paying for the mountain rescue, the ambulance, the emergency room, the surgeon, the anesthesiologist, the operating room, the hospital stay, the physical therapy. That can easily surpass $50,000. What about a sudden cardiac event in Tokyo? You could be looking at a bill well over $150,000 for surgery and a week in the cardiac ICU. A serious car accident in rural France requiring a lengthy hospital stay and multiple procedures? You could be staring down $250,000. Suddenly, that $25,000 policy doesn't look like a safety net. It looks like a coupon. It's a small discount on a life-altering debt. This is why the first thing you must look for is a policy with a robust overall maximum limit. My personal rule of thumb? Never ever consider a policy with less than $100,000 in medical coverage. It's just not worth the risk. If you are traveling to a remote location, a developing country where you might need to be moved to a better facility, or if you're doing any kind of adventure sports, skiing, scuba diving, even serious hiking, I would strongly recommend looking for policies with $250,000, $500,000, or even $1 million in coverage. The price difference for this massive leap in protection is often shockingly small. We're talking the cost of a few fancy coffees to go from woefully underinsured to completely protected. But the overall maximum limit is only part one of the equation. It's the big friendly number they put in the headline. The real devil is in the details, buried in the fine print. And this brings us to the next two items on our checklist, the evil twins of insurance: the deductible and the coinsurance. Let's start with the deductible. Most of us know this from our regular health insurance. It's the amount of money you have to pay out of your own pocket before the insurance company starts paying for anything. It's your skin in the game, so to speak. If you have a policy with a $500 deductible and you get a $2,000 hospital bill, you pay the first $500, and then the insurance company takes care of the remaining $1,500. Simple enough, right? Wrong. Here is where travel insurance can get incredibly tricky. You need to look for one critical phrase. Is the deductible per incident or per policy period? This is $1 million question hiding in plain sight. A per policy period deductible is what you want. It means you pay the deductible once, and only once, for the entire duration of your trip. If you have a $250 deductible, and you get food poisoning in Italy on day 3, you pay that $250. If you then sprain your ankle in Greece on day 10, your deductible is already met. The insurance covers the new bill from the very first dollar. You are done paying. A per-incident deductible, however, is a trap. It means you pay the deductible every single time you have a new, unrelated medical issue. Using the same example, you pay the $250 for the food poisoning in Italy. Then when you sprain your ankle in Greece, the insurance company says, "Ah, that's a new incident." And you have to pay another $250 deductible before they'll cover the ankle. It's a way for insurance companies to chip away at your coverage, and it can add up incredibly fast on a long or eventful trip. Always hunt for that per policy period language. And while you're at it, look for policies with a $0 deductible. They exist, they are often not much more expensive, and they offer true peace of mind. Now for the other evil twin, coinsurance. This one is even more insidious. Coinsurance is the percentage of the bill you are still responsible for after you've paid your deductible. It's usually expressed as a ratio like 80/20 or 90/10. This means the insurance company pays 80 or 90% of the bill, and you are on the hook for the remaining 10 or 20%. This sounds manageable, doesn't it? Oh, 20%, I can handle that. Let's put that to the test. Remember that $100,000 bill for the severe car accident? Let's say you have a great policy. $0 deductible. Fantastic. But it has an 80/20 coinsurance clause. The insurance company pays its 80%, which is $80,000. You are personally responsible for the other 20%. That's a $20,000 bill that you have to pay out of pocket. $20,000. That is not a minor expense. That is a new car. It's a down payment on a house. It's a devastating, trip-ruining, life-impacting amount of money, and you thought you were fully insured. The gold standard, the only thing you should really be looking for, is a policy that covers 100% of eligible expenses after the deductible is met. No coinsurance. No fuzzy math. You pay your deductible, which is hopefully zero, and they pay the rest all the way up to that big overall maximum limit we talked about. So let's recap this crucial checklist section. When you are looking at a policy's medical benefits, you are looking for a three-part harmony of protection. First, a high overall maximum limit, at least $100,000, and much more for adventurous or remote travel. Second, a low or $0 deductible that is explicitly listed as per policy period, not per incident. And third, 100% coverage for coinsurance so you aren't left holding the bag for a shocking percentage of a massive bill. Getting these three things right is the difference between having a real insurance policy and having a glorified discount card. But even with perfect coverage for the hospital bill itself, there is another, even more terrifying expense lurking in the shadows. An expense that can arise when you're in a place where the local hospital simply isn't equipped to save your life. What happens when the care you need is 1,000 miles away back home, or in a different country entirely? You can't just buy a ticket for a commercial flight when you're on a stretcher and need a medical team to keep you alive. This requires something else entirely. It requires a specialized, private flight that can cost more than a house. It's called a medical evacuation, and if your policy doesn't cover it properly, it's the one thing that can lead to absolute financial ruin, no matter how good your health coverage is. Let's break down exactly what that means. Imagine a guy named Mark from Colorado. He's 45, in great shape, and an experienced hiker. He's saved up for years for his dream trip, a 2-week trek through the Swiss Alps. He buys a standard travel insurance policy online, glances at the big numbers, $1 million in medical coverage, and figures he's set. He's not a daredevil, just a guy who loves the mountains. On day 5, high up on a trail near Grindelwald, a loose rock gives way. It's a freak accident. Mark tumbles and his leg is shattered in a way that makes you wince just thinking about it. It's a complex fracture of his femur. A Swiss rescue helicopter airlifts him off the mountain. That's the first bill, easily $5,000 to $10,000 right there. They take him to the nearest regional hospital. The care is excellent, the doctors are professional, but it's a small hospital. They can stabilize him, but they don't have the orthopedic subspecialist required for the incredibly complex surgery he needs to save his leg and ensure he'll walk normally again. The Swiss doctor is blunt. He tells Mark, "We can perform a temporary procedure, but for the best long-term outcome, you need to be at a major trauma center. And frankly, your best option is to get this done back home, where your follow-up care, physical therapy, and family support system are." So Mark is lying in a Swiss hospital bed in pain thousands of miles from home, and he's just been told he needs to fly across the Atlantic. But he can't just book a seat on the next United flight. He can't bend his leg. He's on heavy pain medication and needs constant medical monitoring. He requires a specialized air ambulance. This is medical evacuation. He contacts the assistance company for his travel insurance, relieved that he has that $1 million policy. He explains the situation. The assistance coordinator says, "Okay, we're on it." A few hours later, they call back. The logistics are in motion. A private jet, equipped like an ICU with a flight physician and a critical care nurse, is being arranged to fly from a base in Germany to Switzerland, pick him up, and fly him to a top-tier hospital in Denver. The price tag for this single flight? $150,000. This is where the fine print of Mark's policy becomes the most important document in his life. Let's play this out 2 ways. In scenario 1, Mark bought the cheap policy, the one with the flashy $1 million medical headline, but a tiny, buried sublimit for medical evacuation. His policy caps evacuation at just $25,000. The insurance company informs him of this. They will contribute their $25,000, but Mark is now personally on the hook for the remaining $125,000. That dream trip has just become a life-altering financial catastrophe. His retirement savings? Gone. His kids' college fund? Gutted. All because of one line of fine print. Even worse, his policy might have a clause that says they will only evacuate him to the nearest adequate medical facility. The insurance company's doctors review his case and decide that a hospital in Zurich, just 2 hours away by ground ambulance, is adequate. They'll pay for that transfer, but they will not pay to get him home to the United States. So now he's stuck in a foreign country, facing a major surgery alone with a language barrier, and the terrifying prospect of figuring out and paying for how to get home after the surgery, a process that could take weeks or months. Now let's look at scenario 2. Mark bought a robust, comprehensive policy. He paid maybe $100 more for it, but he did his homework. His policy has a separate, dedicated $1 million limit specifically for medical evacuation. It also has the magic words, coverage for evacuation to your hospital of choice or home country. In this scenario, the phone call is completely different. The assistance coordinator says, "Understood, Mark. We've reviewed the medical reports. We agree that repatriation to your home hospital is medically necessary for your long-term recovery. The flight is arranged. A team will be at your hospital tomorrow morning to manage the transfer. Don't worry about the cost. It's fully covered. Your only job is to rest." The relief is unimaginable. The insurance company handles everything: the flight, the medical crew, the ground transport on both ends, coordinating with the sending and receiving hospitals. The $150,000 bill is sent directly to them. Mark gets the world-class care he needs, back in his home city, surrounded by his family, without his life savings being vaporized. This is not an exaggeration. This is the single biggest financial risk you face when you travel abroad. So here is your checklist for this specific, critical benefit. This is non-negotiable. First, look for the medical evacuation line item. Do not assume it's included in the main medical coverage limit. It needs to be its own separate, clearly defined benefit. Second, check the coverage amount. I would consider anything less than $250,000 to be dangerously inadequate. A flight from Europe can easily be over $100,000. From Asia or a remote location in South America can push $200,000 or more. A good policy will offer $500,000 to $1 million in evacuation coverage. Don't cheap out on this. The difference in premium is tiny compared to the risk. Third, and this is the most important part, find out where they will evacuate you to. This is the critical policy language. If you see the phrase "nearest adequate facility," that's a massive red flag. It gives the insurance company the power to send you to a hospital in a nearby city or country, but not back home to the US. You want to see the words "hospital of choice," or more commonly, repatriation to your home country. This guarantees they will bring you all the way back home if it's medically justified. This distinction is everything. It is the difference between being stranded and being saved. Fourth, check if the policy also covers bringing a friend or family member to your bedside if you are hospitalized for an extended period, say, more than 7 days. This is often called bedside visit coverage. It's a huge psychological and emotional benefit during a crisis. They might pay for a round-trip ticket for your spouse or a parent to come and be with you. Finally, while we're on this grim but necessary topic, look for a related benefit: repatriation of remains. Nobody wants to think about it, but in the event of a death overseas, the logistical and financial burden of bringing a loved one home is immense, often costing $10,000 to $20,000. A good travel insurance policy will cover this cost entirely, taking that horrific burden off of a grieving family. So, to recap the evacuation checklist, a separate high-limit benefit, at least $500,000. The magic words "repatriation to home country" or "hospital of choice." And check for added benefits like a bedside visit and repatriation of remains. Getting your body back home in one piece is the absolute priority. But once you're safely in a US hospital, your mind will immediately turn to the mess you left behind. What about the non-refundable 5-star hotel you booked for the second week of your trip? What about the prepaid tours, the rental car sitting in a lot, the business class flight home you're now going to miss? All that money seems to just disappear. Or does it? This is where a completely different part of your policy kicks in, and the rules that govern it are just as tricky and just as important. It's called trip cancellation and trip interruption insurance, and it's probably one of the most misunderstood parts of any travel policy. People think they're the same thing. They are absolutely not. Confusing them can cost you thousands of dollars because they cover you at completely different times for completely different reasons. Let's start with trip cancellation. The name is pretty straightforward. This is the coverage that protects your financial investment before your trip even begins. Think of all the money you pay up front. The non-refundable flights, that beautiful all-inclusive resort, the guided tours you book months in advance. You might spend $5,000, $10,000, even $15,000 before you've even packed your suitcase. Trip cancellation is designed to give you that money back if you have to call the whole thing off. But here is the million-dollar detail. You can't just cancel because you feel like it. You have to cancel for what the policy calls a covered reason. This is not a suggestion. It is a legally binding list. If your reason for canceling isn't on that list, you get $0 back. So, what's usually on the list? The big ones are pretty standard. A sudden unforeseen illness, injury, or death. This could be you, your traveling companion, or a close family member. And by family member, they mean their specific definition of family member, which we'll get to. Other common covered reasons include things like being called for jury duty, your house becoming uninhabitable from a fire or a flood, a documented traffic accident on the way to the airport, or a terrorist incident happening in your destination city within 30 days of your arrival. So let's say you've booked that dream 2-week trip to Italy. Total cost $7,000, all prepaid. A week before you're set to fly out, you get a severe case of pneumonia and your doctor declares you unfit to travel. You send the airline and hotel your doctor's note, but they point to the fine print you agreed to. Non-refundable. You're out $7,000. But with trip cancellation coverage, you file a claim, submit your medical documents, and the insurance company reimburses you for those non-refundable costs. Your trip is gone, but your money isn't. Now, let's talk about what is almost never a covered reason. A breakup with your traveling partner. Your boss denying your vacation request after you already booked. Your pet getting sick. Vague fears about political unrest you saw on the news. Or simply changing your mind. None of these will get you your money back under a standard trip cancellation policy. The reason has to be specific, unforeseen, and on that list. This brings us to trip interruption. This is the coverage that kicks in after you've already left home. You are on your trip, and something goes wrong that forces you to end it early. Let's go back to our story. You're lying in that Swiss hospital with a broken leg. Your epic European adventure was supposed to continue for another 10 days in Rome. You had a non-refundable 5-star hotel booked. You had non-refundable tickets for the train from Zurich to Rome. You had non-refundable tours of the Colosseum and the Vatican. All of that is now useless. You're not going. That's thousands of dollars in prepaid and used trip expenses that are about to vanish. Trip interruption is designed to reimburse you for that forfeited part of your trip. But it does something else, something even more critical. It covers the cost of getting you home. Think about it. Your original return ticket was from Rome 10 days from now. That ticket is now worthless. You need to get home from Zurich as soon as possible on a last-minute flight. And because you have a broken leg, you might need a business class seat with extra legroom, or even require 2 seats. A last-minute, one-way, international flight booked under duress can cost an astronomical amount of money, far more than your original round-trip ticket. Trip interruption covers that reasonable, additional transportation cost to get you back home ahead of schedule. It's a financial lifeline when you are at your most vulnerable. Just like trip cancellation, trip interruption only works for a specific list of covered reasons. The good news is the list is often very similar. Your own injury or sickness, a family member back home having a medical emergency, or a major event like a natural disaster forcing an evacuation from your hotel. Now let's pull back the curtain on the fine print, the little gotchas that everyone needs to know for both of these coverages. First, pre-existing medical conditions. This is a huge one. If you have a known heart condition and you cancel your trip because your doctor advises against it due to that same condition, a standard policy might deny your claim. They'll argue it wasn't unforeseen. Many policies offer a pre-existing condition exclusion waiver, but you often have to buy the policy within a short window, like 14 to 21 days, of making your first trip payment to qualify. You have to read this section of the policy with a magnifying glass. Second, that definition of family member. Your policy will list exactly who counts. It's usually spouses, domestic partners, children, parents, siblings, and grandparents. It almost never includes aunts, uncles, cousins, and certainly not a close friend or a fiancé. So if you have to cancel a trip because your beloved aunt has a stroke, your policy may not cover you unless she was listed as your traveling companion. It sounds cold, but it's how the contracts are written. Third, documentation is everything. You can't just say you were sick. You need a detailed note from a physician. You can't just say there was a death in the family. You will need to provide a copy of the death certificate. If you miss a flight because of a car accident, you'd better have a police report. The burden of proof is always on you. No documentation, no reimbursement. Hearing all these rules and exclusions might make you nervous. What if you just get a terrible feeling about the trip? What if a new, scary virus starts spreading but it's not a formal pandemic yet? What if you get into a major argument with your spouse and the idea of a romantic getaway becomes a nightmare? For these situations, standard cancellation won't help you. But there is an upgrade, a sort of nuclear option in the travel insurance world. It's called a cancel for any reason add-on, often abbreviated as CFAR. It is exactly what it sounds like. You can cancel your trip for literally any reason you want: fear, anxiety, a sick dog, a bad haircut, and get a significant portion of your money back. It offers the ultimate flexibility and peace of mind. But this power comes with some very specific rules and trade-offs. First, it's expensive. A CFAR rider can add 40 to 60% to your policy's premium. Second, you don't get 100% of your money back. Typically, CFAR will reimburse you for either 50% or 75% of your non-refundable trip costs. So if you cancel a $10,000 trip, you'll get back $5,000 or $7,500, not the full amount. Third, and this is crucial, you must buy the CFAR coverage within a strict time frame, usually 14 to 21 days from the date you made your very first payment for the trip. If you wait until day 22, the option is gone forever. And finally, you usually have to cancel your trip no later than 48 hours before your scheduled departure. You can't just not show up at the airport and expect a check. So, is CFAR worth it? It's a personal calculation of risk versus cost. For a once-in-a-lifetime, incredibly expensive honeymoon, paying an extra few $100s for the ability to get 75% of your money back no questions asked might be a brilliant investment. For a cheap weekend getaway, it's probably overkill. So now your health is covered, and your massive trip investment is protected. You've navigated the crisis, you've made it through the claims process, and you finally make it home, exhausted but financially whole. You wait at the baggage carousel, and your suitcase never appears. Or maybe it does, but it looks like it was used as a speed bump for the catering truck. What happens then? That little line item on your policy for baggage and personal effects suddenly becomes the most important sentence in the world, and the rules that govern it are just as specific and just as vital to understand. Let's start with that single line item because it's where most travelers get a very expensive, very frustrating education. You see a policy that says, $2,500 for baggage and personal effects, and you think, great. My new laptop cost $2,000, my camera was $1,000, and my noise-canceling headphones were $350. I'm more than covered. And that right there is the trap. Because that one number, that big, friendly $2,500, is almost never the number that actually matters. Buried deep in the fine print are two other numbers that will make or break your claim. The first is the per-item limit. This is the absolute maximum the insurance company will pay for any single item, regardless of its actual value. It's often shockingly low. You might have a $2,500 overall limit, but the per-item limit could be just $500. So when your $2,000 laptop gets crushed by that catering truck, they're not going to write you a check for $2,000. They're going to look at their policy, point to the per-item limit, and send you $500. You're still out $1,500, and your dream of editing vacation videos by the pool is gone. But it gets even more granular. The second number to look for is the specific category sublimit. Insurance companies know what people travel with. They know you have electronics, jewelry, and maybe some expensive sporting gear. So they create special, even lower limits for these categories. Your policy might have a $500 per item limit in general, but a specific sublimit of only $250 for all electronics combined. So now your $2,000 laptop, your $1,000 camera, and your $350 headphones are all fighting for a slice of a tiny $250 pie. It's infuriating, but it's right there in the policy you agreed to. Imagine you're a photographer. You've packed your main camera body, 2 expensive lenses, and a drone. That's probably $10,000 of gear in one bag. If that bag gets stolen from your hotel room, and your policy has a $500 sublimit for photographic equipment, you are in for a world of hurt. This is why you cannot just look at the headline number. You have to play a little game of what if with your own packing list. Before you buy a policy, make a mental list of the 3 most expensive things you're taking with you. Your laptop, your engagement ring, your new set of golf clubs. Now, go find the policy documents, not the marketing page, the actual boring PDF of the policy wording, and search for the section on baggage. Find those 2 numbers, the per item limit and the specific sublimits for categories like electronics, jewelry, or sporting goods. If the value of your items is way higher than those limits, that policy's baggage coverage is practically useless for you. And there's one more concept that feels like a punch in the gut when you first encounter it: depreciation. Insurance doesn't pay you what you paid for your items. They pay you what your items are worth today. This is called actual cash value. Your 3-year-old MacBook might have been $2,000 new, but in the eyes of an insurer after 3 years of use, it might only be worth $800. So even in a best-case scenario where your per-item limit is high enough, they're still only going to pay you the depreciated value. Think of it like trying to sell your car. You can't sell a 5-year-old Honda for the same price you paid for it brand new. It's the same principle, and it means you'll almost never get back the full replacement cost unless you specifically buy a policy with replacement cost coverage, which is rarer and more expensive. So, how do you actually make a claim and win? Comes down to proof. You can't just say your bag with a Rolex and a laptop was stolen. You have to prove 2 things: that you owned the items and that they were lost or stolen. Proving ownership starts before you even leave your house. This is your pre-trip homework. For every expensive item you're packing, take a picture of it. Even better, take a picture of the item with its serial number visible. Find the original receipts if you can and scan them, or save a digital copy to the cloud. If you don't have receipts, a credit card or bank statement showing the purchase works just as well. Create a folder in your Google Drive or Dropbox called Travel Insurance Docs, and put all of it in there. It might feel like overkill, but if you need it, this little folder will be worth its weight in gold. Without proof of ownership, your claim is dead on arrival. Proving the loss is just as critical. If your belongings are stolen, the first thing you must do, before you even call the insurance company, is go to the local police and file a report. This is non-negotiable. Insurance companies need official documentation that a crime occurred. A police report is that documentation. Get it as soon as you possibly can. Don't wait a day. Don't think, "I'll deal with it when I get back to the hotel." Go straight to the police station. And here's a pro tip: be as detailed as possible in your report. List every single significant item that was taken. If you remember later that your expensive sunglasses were also in the bag, it's much harder to add them to the claim if they aren't on the original police report. Ask for a copy of the report right then and there. If it's in another language, use a translation app to get the gist of it, and ask if an English version is available. The same goes for if an airline loses or damages your bag. You must file a report with the airline at the airport. This is called a Property Irregularity Report, or PIR. Do not leave the airport without this piece of paper. That report is your proof that the airline, a third party, is responsible for the loss. Without it, the insurance company will likely assume you just misplaced your bag somewhere and deny the claim. And then there's the clock. Almost every policy has a strict time limit for reporting an incident. It's usually 24 to 72 hours. You have to notify the insurance company's 24/7 assistance line within that window. If you wait a week until you get home to call them, they have grounds to deny your claim simply because you didn't follow the rules. So the sequence of events is critical. Incident happens. Immediately file a report with the police or airline. Then call your insurance provider. Finally, you have to understand the exclusions. Baggage coverage doesn't cover everything. Cash is almost never covered. Neither are things like event tickets, gift cards, or traveler's checks. The number one reason for denied claims is leaving your baggage unattended. What does that mean? It means leaving your backpack on a chair in a cafe while you go up to the counter to order. It means leaving your suitcase by the hotel concierge bell desk, if they haven't formally checked it in and given you a claim ticket. If you cannot see and physically touch your bag, an insurer will likely consider it unattended. It's harsh, but their logic is that you didn't take reasonable care to protect your property. Simple wear and tear isn't covered either. If your old suitcase finally gives up and a wheel falls off, that's on you. It has to be damage from a specific reportable incident. So, this part of your insurance, the part that covers your stuff, is a minefield of sublimits, depreciation, and strict rules about reporting. It's a fantastic safety net to have, but only if you understand its limitations before you need it. It's about checking those per-item limits against your packing list, doing your homework by documenting your valuables, and acting fast with police reports if the worst happens. But let's be honest, losing a laptop is a disaster, but it's a replaceable disaster. It's a financial problem. The real, trip-ending, life-altering catastrophes aren't about what's in your suitcase. They're about the things you can't replace. What happens when it's not your luggage that gets lost, but the trip itself? What happens when a hurricane decides to park itself directly over your all-inclusive resort 2 days before you're scheduled to fly out? Or when a sudden family emergency back home means you have to abandon your tour of Italy and get on the next flight, no matter the cost. That's when we move beyond the world of lost luggage and into the powerful and equally complex world of trip cancellation and trip interruption insurance. And the rules that govern that are even more important. These two benefits, trip cancellation and trip interruption, sound similar, but they operate in two completely different phases of your journey, and knowing the difference is the key to protecting your investment. Think of it this way. Trip cancellation protects your money before you leave. Trip interruption protects you and your money after you've already gone. Let's start with trip cancellation because this is where the big money is saved. You've just booked that dream 2-week tour of Italy. You've paid for the flights, the hotels, the guided tour of the Colosseum, the cooking class in Tuscany. It's thousands of dollars in prepaid, non-refundable costs. Then, 1 week before you're supposed to fly to Rome, you slip on some ice walking to your car and break your leg in 3 places. Your doctor looks at you and says, "You are absolutely not flying anywhere." You call the airline. They say, "Sorry, it's a non-refundable ticket. We can give you a credit, but there's a $300 change fee." You call the tour company. They say, "Our policy is clear. No refunds for cancellations within 30 days. Just like that, $5, $6, maybe $10,000 is about to vanish. This is the exact moment trip cancellation insurance becomes your financial superhero. It's designed to reimburse you for those prepaid, non-refundable expenses if you have to cancel your trip for a covered reason. And that phrase, covered reason, is the most important part of this entire conversation. This is not "I changed my mind" insurance. It's not "I broke up with my boyfriend and don't want to go with him anymore" insurance. It's insurance for specific, unforeseen events that are explicitly listed in your policy document. So what are these magical covered reasons? The most common and important one is the one we just described. A sudden, unexpected illness, injury, or medical condition that's so severe a doctor advises you against travel. This doesn't just apply to you. It also covers your traveling companion, and critically, it often covers your non-traveling family members. Imagine you get a call that your mother back in Seattle has had a stroke. You obviously need to cancel your trip to be with her. That's a covered reason. Another major one is the death of a traveler or a family member. It's a horrible thing to think about, but it's a reality the policy is built for. Then there are the less dramatic but equally trip-destroying life events. Things like being laid off from your job. But there are rules. You can't just quit and expect a payout. You typically have to have been employed with the same company for a continuous period like 1 to 3 years, and the layoff has to be through no fault of your own. You can be covered for being called for jury duty or being legally subpoenaed to appear in court, provided you couldn't get it postponed. Your home being made uninhabitable by a fire, a flood, or a natural disaster is another classic covered reason. And speaking of disasters, severe weather is a big one. Let's say a hurricane is barreling towards your resort in the Caribbean. If it causes your airline or cruise line to completely cease services for at least 24 to 48 hours, your cancellation will likely be covered. But if the airline is still flying even into a storm and you just get scared and decide not to go, that's probably not covered. The event has to officially stop your travel plans. The list goes on. A traffic accident on the way to the airport, a documented theft of your passports right before you leave, even a terrorist incident occurring in your destination city within a certain number of days of your planned arrival. Each policy is a contract, and the covered reasons are the terms of that contract. You have to read them. Now let's flip the coin. What happens if you make it to Italy? The flight was smooth, you're 4 days in, you've seen the Colosseum, you've tossed your coin in the Trevi fountain. And then you get that call. The emergency isn't something that prevents you from going. It's something that forces you to come home. Right now. This is trip interruption. Trip interruption covers the exact same kinds of reasons as trip cancellation. A sudden illness, an emergency back home with a family member, your house burning down. But its benefits are twofold, and this is crucial. First, it reimburses you for the unused portion of your trip. You paid for a 14-day tour, but you only used 4 days of it. The insurance will refund you the prorated costs for those 10 days you're going to miss. The hotel nights, the pre-booked train tickets from Rome to Florence, the guided tours, it's all covered. But here's the second and arguably more powerful benefit. Trip interruption pays for the cost of getting you home. Think about what a last-minute, one-way flight from Europe to the United States costs. It can be astronomical, $2,000 or more. Trip interruption covers the extra cost to get you from where you are back to your front door. It's not just about recouping what you lost. It's about covering the massive new expense of an emergency evacuation. So, cancellation is for when the disaster stops you from ever leaving your driveway. Interruption is for when the disaster finds you thousands of miles from home, and you need to get back. But what if your reason for canceling isn't on that neat little list? What if you're a wedding photographer, and a massive career-making gig just came up that conflicts with your vacation? What if the CDC issues a level 2 travel warning for your destination that just makes you feel uneasy, but isn't an official do not travel? What if your pet sitter cancels at the last minute? None of those are standard covered reasons. You'd lose all your money, unless you have the ultimate upgrade, a cancel for any reason policy or CFAR. This is exactly what it sounds like. It's an add-on to a comprehensive policy that lets you cancel your trip for literally any reason under the sun. Fear, work, a change of heart, a bad horoscope, anything, and still get some of your money back. But this power comes with some very strict rules and limitations. First, it's expensive. A CFAR rider can increase the price of your insurance premium by 40 to 60%. It's a significant extra cost. Second, you don't get 100% of your money back. Most CFAR policies will only reimburse you for 50% or, at best, 75% of your non-refundable trip costs. So it's not a get-out-of-jail-free card. It's a safety net to soften the financial blow. You're still losing a chunk of change. Third, and this is the one that trips most people up, you have to buy it very soon after you make your first payment on the trip. You can't wait until you get nervous a week before you leave. The purchase window is usually very tight, within 10 to 21 days of your initial trip deposit. And finally, you have to cancel your trip in advance, typically at least 48 hours before your scheduled departure. You can't just be a no-show at the airport and expect a check in the mail. So CFAR is a powerful tool, but it's for a specific type of traveler. Someone with a very expensive, complex trip, who has legitimate concerns that fall outside the standard list of covered reasons, and is willing to pay a premium for that flexibility, knowing they won't get all their money back. So we've covered how to protect the money you spent before you go, and how to get home if things go wrong. But what happens if the emergency isn't back home? What happens if the emergency is you lying in a hospital bed in a foreign country? That's when the single most important part of your policy kicks in: emergency medical coverage. And the numbers there can be staggering. When you see a policy that offers $50,000 in emergency medical coverage, it sounds like a lot of money. And it is, until it isn't. Let's imagine you're skiing in the Swiss Alps. You take a bad fall. You hear a snap. That's your femur. The ski patrol has to get you off the mountain in a sled. Then a helicopter has to airlift you to the nearest hospital. That helicopter ride alone can cost you $10,000 to $20,000. Then comes the emergency surgery, the metal rod they have to put in your leg, the anesthesia, the surgeon's fees. You're in the hospital for a week, maybe 10 days recovering. In a place like Switzerland, a single night in a hospital bed can run you $1,000 or more. By the time you're cleared to fly, and you'll need a business class seat so you can elevate that leg, you're looking at a bill that could easily push past $60,000, $70,000, even $80,000. Suddenly, that $50,000 policy doesn't look so big anymore. It looks like a $20,000 or $30,000 debt you're bringing home as a souvenir. This is the absolute heart of your travel insurance policy. It's the reason we're even having this conversation. Your U.S. health insurance, whether it's through your employer, Medicare, or the marketplace, will almost certainly provide little to no coverage outside the United States. They might cover you in a U.S. territory, but once you're in Paris or Tokyo or Lima, you are on your own. You are a cash customer. And if something serious happens, you will be expected to pay. So what's the right number? For emergency medical coverage, I would consider $50,000 the absolute rock bottom minimum. That's for a simple trip to a country with relatively affordable healthcare, like Mexico or Thailand. But for true peace of mind, especially if you're traveling to Europe, Australia, or any developed nation, you should be looking for a policy with at least $100,000 in coverage. $100,000 is the new standard. It provides a strong buffer against the unexpected. If you're older, have any health concerns, or are traveling to a more remote destination where a medical issue could become complicated, I'd strongly recommend looking for policies with $250,000 or even $500,000. They exist, and the price difference is often surprisingly small for the massive leap in protection you get. But there's a sneaky detail here you have to watch out for. Is that coverage limit, say $100,000, an overall maximum, or is it a per incident limit? Most comprehensive plans use an overall maximum, which is what you want. It means the policy will pay up to that total amount for all medical issues you have on your trip. A cheaper, less reliable policy might have a lower per incident limit, which could be a disaster if you have a complicated accident that leads to secondary issues, like an infection. Always look for that overall maximum language. Now let's escalate the scenario. The broken leg in the Alps was bad, but the hospital they took you to was world-class. What if that's not the case? What if you're on a safari in Tanzania, or trekking in the Himalayas, or on a small cruise ship in the middle of the South Pacific, and you have a stroke or a heart attack? The local clinic, if there even is one, might just be a small building with a nurse and some basic supplies. They can't perform heart surgery. They don't have a neurology department. They can stabilize you, but they can't save you. This is when the single most expensive thing in the world of travel kicks in: emergency medical evacuation. This isn't a commercial flight. This is a private air ambulance. A small jet, staffed with a doctor and a nurse, filled with life-saving medical equipment, that is dispatched to your location to pick you up and fly you to the nearest hospital that can actually handle your condition. That hospital might be in another country. It might be halfway around the world. The cost for this service is astronomical. A medical evacuation from a Caribbean island to Miami can cost $50,000. From Europe to the US, it can easily exceed $100,000. And from a remote location in Asia or Africa, you could be looking at a bill for $250,000. This is not an exaggeration. These are real numbers. And without insurance, the company operating that air ambulance will want a credit card or a wire transfer before the wheels even leave the ground. This coverage is, in my opinion, even more critical than the basic medical coverage. Because a $100,000 medical bill is life-altering, but a $200,000 evacuation bill is something most people could never ever pay. So what's the magic number for evacuation? Do not even consider a policy with less than $250,000 in medical evacuation coverage. That's the floor. The gold standard, and what I personally look for, is $500,000. If you are doing any kind of adventure travel, going to very remote places, or taking a cruise, I would strongly advise finding a policy with $1 million in coverage. It sounds like overkill, but that's the kind of bill you could face if you need a complex long-distance evacuation. And tied to this is a small, morbid, but absolutely essential detail: repatriation of remains. If the worst should happen and a traveler passes away abroad, this coverage pays for the complex and expensive process of transporting their body back home. It's a terrible thing to think about, but for a grieving family, having an insurance company handle the logistics and the cost, which can be $10,000 to $15,000, is an incredible relief in a time of unimaginable stress. Don't overlook it. Now for the biggest trap of all. The one thing that invalidates all of this amazing coverage we've just talked about. The ultimate gotcha in the world of insurance: pre-existing medical conditions. Let's say you have high blood pressure. It's well controlled with medication you take every day. 3 months before your trip to Italy, your doctor adjusts your dosage. While in Rome, you have a serious cardiac event related to your blood pressure. You rack up $100,000 in medical bills. You file a claim, and the insurance company denies it. Why? Because the change in your medication dosage means your condition was not considered stable for their look-back period, typically 60 to 180 days before you bought the policy. Your high blood pressure was a pre-existing condition, and they won't cover anything related to it. All that money you spent on the policy, wasted. This is where millions of travelers, especially those over 50, get burned. But there is a way to protect yourself. It's a feature called the pre-existing condition exclusion waiver. This waiver effectively erases that exclusion, meaning the insurance company agrees to cover your pre-existing conditions, just like any new illness or injury. Getting this waiver is the single most important thing for many travelers to do, but it is incredibly time-sensitive. To qualify for it, you typically have to meet 3 conditions. 1. You must buy your travel insurance policy within a short window, usually 14 to 21 days, of making the very first payment on your trip. That could be your flight, your cruise deposit, or your tour package. The clock starts ticking from that first dollar you spend. 2. You must insure the full, non-refundable cost of your trip. You can't just insure your flights but not your prepaid hotels. And 3. You must be medically fit to travel on the day you buy the policy. If you do those 3 things, most comprehensive policies will grant you the waiver. If you wait a month to buy your insurance, you've lost your chance. That waiver is gone, and so is your coverage for anything related to your existing health. This is why you should always buy your travel insurance at the same time you book your trip. Finally, one last major exclusion: adventure. Most standard, vanilla travel insurance policies are designed for people visiting the Louvre, not for people climbing Mount Kilimanjaro. If you get injured while scuba diving, ziplining, or even skiing on a marked trail, your standard policy may deny your claim, stating that you were engaging in a hazardous activity. You have to read the fine print. Search the policy document for the specific activity you plan to do. If it's excluded, you need to either buy a special adventure sports rider or find a policy from a company that specializes in more adventurous travel. Otherwise, you're climbing that mountain completely uninsured. We've just covered the catastrophic, the life and death scenarios that can cost hundreds of thousands of dollars. But let's be honest, those are rare. What isn't rare? What's the stuff that happens all the time? The stuff that turns a dream vacation into a waking nightmare of frustration. That's your airline canceling your flight, the airport losing your luggage, or your wallet getting stolen in a crowded market. That's where the other half of your policy comes into play, and frankly, it's the part you are far more likely to ever use. Let's pull back the curtain on these travel benefits, because they are the unsung heroes of any good policy. We'll start with the big one, the one that protects your wallet before you even pack your bags: trip cancellation. Imagine this. You and your partner have been planning a 2-week dream trip to Italy for a year. You've saved up. You booked non-refundable flights, prepaid for that gorgeous villa in Tuscany, and put down a deposit on a cooking class in Florence. You're all in for about $8,000. Then 3 weeks before you're scheduled to leave, your father has a serious, unexpected heart attack. He's in the hospital, and the doctors say recovery will be long. You are not going to Italy. You can't. This is the gut punch. Not only are you dealing with a family crisis, but you're also staring down the barrel of losing $8,000. You call the airline, the villa owner. They all say the same thing. We're so sorry to hear that, but our policy is non-refundable. This is precisely what trip cancellation coverage is for. It reimburses you for 100% of your prepaid, non-refundable trip costs if you have to cancel for a covered reason. And that phrase, covered reason, is the most important part. So what counts? Typically, the list includes things you'd expect: the unforeseen sickness, injury, or death of you, your traveling companion, or a close family member. That's the big one. But it also covers things you might not think about. You're called for jury duty. You're laid off from your job. Your home is made uninhabitable by a fire or a flood. A terrorist incident occurs in your destination city within 30 days of your arrival. These are the standard named perils that allow you to pull the plug on your trip and get your money back. Now, what if your reason for canceling isn't on that list? What if your pet gets sick? Or you have a major falling out with your travel partner? Or let's be honest, you just get a massive wave of anxiety and decide you don't want to go anymore? For that, there's a special premium upgrade called Cancel for Any Reason Coverage, or CFAR. Think of CFAR as the ultimate escape hatch. It's significantly more expensive, often adding 40 to 60% to the cost of your base policy. And it doesn't reimburse you 100%. Typically, it pays back between 50 and 75% of your trip cost. There are also strict rules. You usually have to buy it within 14 to 21 days of making your first trip payment, and you must cancel your trip at least 48 hours before departure. It's not for everyone, but if you're booking a once-in-a-lifetime, incredibly expensive trip and you want absolute peace of mind, it's an option worth considering. Okay, so that's canceling before you go. But what happens if the crisis hits while you're already on your trip? That's where a different, but equally vital, benefit kicks in: trip interruption. Let's go back to our Italy example. But this time you're already there. You're 1 week into your trip, standing in front of the Colosseum in Rome, when you get the call about your father. You have to go home. Now, a last-minute, one-way flight from Rome to New York is going to cost a fortune, maybe $2,000 per person. Plus, you're walking away from the second week of your trip, that prepaid Tuscan villa and cooking class, that you'll never get to use. Trip interruption is designed for this exact nightmare. Covers 2 major things. First, the cost of that emergency one-way ticket home. Second, it reimburses you for the unused portion of your trip, so you get the money back for that second week in Tuscany. The covered reasons for trip interruption are almost always the same as for trip cancellation. It's a financial lifeline that allows you to focus on the emergency at hand without also worrying about the money you're leaving on the table. It can often reimburse you up to 150% of your trip cost to cover those expensive last-minute fares. Now let's shift from the major crises to the more common, infuriating headaches of travel. Let's talk about trip delay. You're flying from Boston to Belize for a scuba diving trip. You have a layover in Miami, but while you're in the air, a massive thunderstorm system rolls into South Florida. Your connecting flight is canceled. The next available flight isn't for 36 hours. You are stuck. The airline gives you a sad little meal voucher, but a hotel for 2 nights plus food and transportation? That's on you. And in a major city like Miami, that can easily add up to $500 or $600 you hadn't budgeted for. Trip delay coverage reimburses you for these exact expenses. It covers reasonable costs for lodging, meals, and local transport when your trip is delayed for a covered reason, like severe weather, a mechanical breakdown of the aircraft, or an airline strike. But there's a key detail you have to watch: the time trigger. Most policies won't kick in until you've been delayed for a specific number of hours. It could be as short as 3 hours or as long as 12. So if your policy has a 12-hour trigger and your flight is delayed for 10, you get nothing. This is a critical point of comparison when you're shopping for plans. A shorter time trigger is always better. And that brings us to the number 1 most common travel mishap: baggage issues. This coverage is split into 2 parts: baggage delay and baggage loss. Baggage delay is for when your checked bag takes a little vacation of its own. You land in London, but your suitcase decides to see Paris first. You're standing at the carousel, empty-handed, with nothing but the clothes on your back. Baggage delay coverage provides a fixed amount of money, say $150 to $300, to buy essential items: toiletries, a change of underwear, a new shirt, a phone charger. It's designed to tide you over until you're reunited with your stuff. Just like trip delay, this benefit has a time trigger, usually 6 to 12 hours. But what if your bag isn't just delayed? What if it's gone forever? Lost by the airline or stolen from your hotel room? That's when you need baggage and personal effects loss coverage. This reimburses you for the value of your lost, stolen, or damaged belongings, up to a certain overall limit, like $1,500 or $2,500. But here's the fine print that trips everyone up. First, that reimbursement is for the depreciated value of your items, not the cost of buying them new. Your 5-year-old laptop isn't worth what you paid for it. Second, and this is crucial, there is almost always a per item limit. The policy might have a $2,500 overall limit, but a per item limit of only $250. And they'll often have a specific, even lower limit for valuable items like jewelry, electronics, or cameras. So if your stolen bag contained your $2,000 camera and a $1,500 laptop, you are not getting $3,500 back. You might only get $250 for the camera, $250 for the laptop, and a bit more for your clothes. This is why you should never, ever pack truly irreplaceable or highly valuable items in your checked luggage. Your homeowner's or renter's insurance might offer better coverage for these items, so check those policies as well. For all of these travel benefits, cancellation, interruption, delay, and baggage, there is one golden rule that overrides everything else. You must have documentation. You cannot just call the insurance company and say, "My flight was delayed." You need proof. You need receipts for everything you buy: the hotel, the meals, the taxi. You need the official statement from the airline detailing the reason for the delay and its duration. If you cancel a trip for a medical reason, you will need a detailed note from a physician. If your wallet is stolen, you need a police report. You have to become a documentation fanatic. Keep every receipt. Take screenshots of every notification. Get everything in writing. A claim without proof is a claim that will be denied every single time. We've covered the medical nightmares and the travel disasters. We've looked at the fine print and the hidden traps. You now know more than 95% of travelers about what this insurance actually does. But there is one final critical benefit we haven't touched on. It's the one you hope you never ever need, but if you do, it will be the most important purchase you have ever made. And there's also one place, one type of company, that you should almost never buy your travel insurance from if you want a policy that will actually protect you. That company is the airline you're flying with, or the online travel agency you're booking through. I know it's tempting. You're in the flow of booking your flight, you're excited, and then a little pop-up appears. Protect your trip for just $29. Feels so easy, so integrated. But that convenience is a trap. It's a classic upsell, and the product you're being sold is almost always a watered-down, bare-bones policy that is riddled with more holes than a block of Swiss cheese. Think about it. What is the airline's primary business? Selling you a seat on a plane. What is the booking site's business? Taking a commission for selling you that seat in a hotel room. Insurance is an afterthought for them, a way to squeeze a few extra dollars out of the transaction. They partner with a third-party insurer to offer a generic one-size-fits-all plan that often has shockingly low coverage limits. We're talking maybe $10,000 or $20,000 in medical coverage, which, as we've established, would barely cover the cost of a gurney ride in some countries. Their medical evacuation limits are often a fraction of what's needed, and their definitions for trip cancellation are so narrow that almost nothing qualifies. You're buying a product designed for their profit margin, not for your protection. The moment you need to file a claim, you'll discover the labyrinth of exclusions and the difficulty of getting a real person on the phone who can actually help. You're not their primary customer, the airline is. So where should you buy it? You have two main paths and both are infinitely better. The first is through a dedicated travel insurance comparison site. Think of them as the Kayak or Expedia for insurance. Websites like Squaremouth or InsureMyTrip allow you to enter your trip details, your age, your destination, your trip cost, and they will instantly pull up dozens of policies from a wide range of reputable, specialized insurance companies. You can then filter and compare them side by side, line by line. You can see the exact medical coverage, the evacuation limits, the pre-existing condition rules, everything. It puts the power back in your hands, allowing you to find the absolute best coverage for your specific needs at the most competitive price. It's transparent, and it's what I personally use for most of my trips. The second path is to go directly to a well-regarded, dedicated travel insurance provider. Companies like World Nomads, Safety Wing, Allianz Travel, or GeoBlue have built their entire reputation on providing robust coverage for travelers. They understand the nuances of international travel. World Nomads, for instance, is famous for covering a huge list of adventure sports. Safety Wing is popular with digital nomads for its subscription-style health coverage that works at home and abroad. Allianz is a massive, established player with a global network. Going direct is a great option if you've done your research and found a company whose specialty aligns perfectly with your travel style. The bottom line is this: buy your insurance from a company whose only job is to provide great insurance. Don't buy it from a company whose main job is to fly you to Cleveland. So, to bring this all home, to consolidate everything we've talked about into a powerful tool you can use every single time you travel, here it is. The ultimate U.S. traveler's health insurance checklist. Pull out your phone and put this in your notes because this is the final exam. First, emergency medical coverage. Does the policy offer at least $100,000 in coverage? For travel to Europe, Japan, or other expensive regions, or for more remote travel, are you aiming for $250,000 or more? Do not compromise on this. This is the number one reason you are buying the policy. Second, medical evacuation and repatriation. This is not the same as medical coverage. Does the policy have a separate high limit for this? You are looking for a minimum of $500,000. $1 million is better. And critically, does it specify evacuation to the hospital of your choice, or home? Or does it just say to the nearest adequate facility? That distinction could mean the difference between recovering in your own bed or in a hospital thousands of miles from everyone you know. Third, pre-existing conditions. Do you or a traveling companion have any? If so, does the policy offer a waiver for pre-existing conditions? And what are the rules to get it? You almost always have to buy your policy within a specific window, usually 14 to 21 days, after making your very first trip payment. Set a calendar reminder. Missing this window can invalidate your claim. Fourth, activities and exclusions. Make a list of everything you plan to do. Are you skiing, scuba diving, rock climbing, or even just riding a scooter in Southeast Asia? Read the policy to see if these activities are explicitly covered or excluded. If they're excluded, do you need to buy an add-on or a special adventure sports rider? Also, check the destination itself. Are there any U.S. government travel advisories that might void your policy? Is there a general exclusion for pandemics, war, or political unrest? Know before you go. Fifth, trip cancellation and interruption. What are the covered reasons for cancellation? Does it include things like a non-traveling family member getting sick, you being required to work, or a hurricane hitting your destination? If you want the ultimate flexibility, are you considering a cancel for any reason, or CFAR policy? Remember, it costs more and will only reimburse about 50 to 75% of your costs, but it gives you total control. Sixth, the nitty-gritty of the policy document. You must look beyond the marketing brochure. Download the full policy document, the long, boring PDF. Use the search function. Look for the definitions section to see how they define a family member or a pre-existing condition. Then, find the exclusions section. This is the most important part of the entire document. It's where the insurance company tells you exactly what they will not pay for. Read every single word. Also, what is your deductible? Is it per incident or per policy? And finally, 7th, 24/7 emergency assistance. This is your lifeline. Does the company provide a global 24/7 collect call-enabled phone number for emergencies? Before you buy, you can even call the number to see if a real, helpful human answers. This isn't a customer service line for billing questions. This is the team that will arrange a helicopter off a mountain or coordinate a payment guarantee with a foreign hospital, so they will admit you. Their competence is non-negotiable. That's the checklist. Medical evacuation, pre-existing conditions, activities cancellation, the fine print, and 24/7 assistance. If you vet your policy against these 7 points, you will be in the top 1% of prepared travelers on the planet. Imagine for a second that you're hiking in the Swiss Alps. The view is incredible, but you take one wrong step on a patch of loose gravel. You hear a snap. Your ankle is broken badly. You're miles from the nearest road. In one reality, you didn't bother with insurance, or you just clicked the cheap airline add-on. Panic sets in. How do you call for help? Who pays for the helicopter rescue? The Swiss hospital asks for a $100,000 deposit before they'll even do surgery. Your trip is over, and you're now facing a mountain of debt that could follow you for years. Now imagine the second reality. Before you left, you used this checklist. You bought a robust policy with $1 million in evacuation coverage. You pull out your phone, you call the 24/7 assistance number you saved. You say, "My name is so-and-so, here is my policy number. I'm injured at these coordinates." And the calm voice on the other end says, "Okay, we're dispatching a helicopter. We will handle the payment guarantee with the hospital in Zurich. Don't worry about anything. We've got you." The injury is the same. The situation is the same. But the outcome is a world apart. One is a catastrophe. The other is a manageable crisis, a good story to tell later. That is the power of being prepared. That is the value of true travel insurance. It's not just a piece of paper, it's peace of mind. It's the freedom to be adventurous, to explore the world, and to know that if the worst happens, you have a global safety net ready to catch you. Travel with confidence, not just with a ticket. Be prepared. Be safe. If this guide gave you even one piece of information that could save you from a disaster down the road, please share your own travel insurance story. The good, the bad, the ugly, in the comments below. Your experience is valuable and could help another traveler in this community make a smarter choice. And of course, if you want to become a safer, savvier global citizen, make sure you hit that subscribe button and ring the notification bell. We have so much more to share. Thanks for watching.